Hello, Mavericks. How's it going? This is Rob Reinhold, and this is the week of June 6th to the 10th. I'm joined by Mr. Darren Fisher, and let's jump into the week that we just had. So let's start off with the news. What happened last week? We had the markets consolidating last week's bounce. Last week, we went up about 6%. This week was a hot mess. It was a hot mess. And both Darren and I, we talked earlier and just said, boy, this market was a mess because there were a few days there where it looked like it was going to give up all of the gains it made last week. There were some really terrible points during this last week. And then it would rally off the bottom. And then Thursday, we get this massive rally and we close at the high. And all of a sudden now people are like, oh my gosh, we're breaking out to the upside. Friday comes and we just get slapped right back down. Now, I am of the opinion that this market is going to screw as many people as it possibly can. Darren, what do you think?
Absolutely. It was looking at the action. So markets were closed Monday, obviously for Memorial Day. Tuesday looked like it was trying to shape up to be a doji. You had Wednesday was a bearish engulfing. Thursday was a bullish engulfing, and now we got an inside candle on Friday. This is one of those ones where you're looking at it, and it is a hot mess. You are absolutely right. If you go long, you're going to get stopped out. If you go short, you're going to get stopped out. And it's one of those ones where this is just neurotic trading. And I don't know about you, but I stayed out of the ugliness last week. And I'm going to wait till we get a trend again, because this is the type of things that will just grind an account away. And I'm happy to let someone else jump on that grenade.
No, and you're right, Darren. And like for me, I kept everything very short term, like almost day trade short term, or I'm out like 6 weeks. I think the 2 to 3 week swing trade time frame is almost impossible in this market. Now, look, that being said, we have really good trends in place in some of the sectors. So you can absolutely still make money out there in trading along that time frame, but you definitely have to be in the right place. Now, I also wanted to bring up Microsoft. Microsoft came out and lowered numbers, and they started the day down 4%. And by the end of the day, they were positive. One of the signs of a market bottom is when bad news no longer pushes stocks down. And we had several companies come out with bad news, and their stocks didn't go down. That being said, everything got sold off. When it started to get some strength, it got sold off. So I'm not saying that was the bottom. I'm not saying that we're out of the woods yet. But when I see stuff like Microsoft warn, gap lower, and then get bought up during the day, that's stuff you see at bottoms. As far as the economic reports go last week, we got manufacturing, both the manufacturing and the ISM services number. The manufacturing number better than expected. The services number slightly less than expected. So, a mixed bag there. And then we got the payrolls report. The jobs report actually came in better than expected. 390,000 jobs created and a little bit light on wages, but that's actually a good thing. People don't want to see that wage inflation getting too hot. Let's take a look at the markets themselves, and let's take a look at returns. So basically, let's call it a drop of 1%. So we jumped 6% the week before. In the end, we gave back 1%, but it was a messy week. Just like Darren said, I mean, look at just the sloppiness. So at one point on Tuesday, we were up. At one point on Tuesday, we were down probably like 2.5%. By the end of the day, we end up in the middle. I mean, just think about that. That's probably a 1.5% move to the upside, a 3% move down, and then a 1.5% move back to the middle. And then we gap up the next day and do nothing but sell off. But at the end, we get a little bit of a bounce. We open up the next morning, sells off, rallies to a high, and then we gap down and just do nothing. This is tough price action. If you are trying to be directional, if you're saying, I think this is going to go up, I think this is going to go down, this is going to be a really tough market. And I hate to break it to you, my opinion is that this stays through probably the rest of the summer. I know that's not a great thing. So, look, we have a saying at Maverick: trade the market in front of you, not the market you want it to be, not the market you think it should be, but the market in front of us. And the market in front of us right here, right now, is kind of a mess. So short term, I'm going to put in support resistance lines here and here. And until anything breaks, it is like I don't want to even stick my neck out for anything directionally. Down here, I've got a 50 or a 20-day moving average, and up here, I've got a 50. Those are going to be my next lines in the sand, where if we can go above or below one of these moving averages, then I think the trend is back on. But until then, I think we're listless. Anything to add, Darren?
No, that's a pretty good call right there, and I'd draw those lines in the exact same places. It's going to be interesting, though. This would make me a little bit more bullish. If that 50-period moving average, if we just continue to go sideways and that 50-period moving average has time to catch up and can cut through the middle of the price action, I think then we have an opportunity we have enough of a base, enough energy built up that we could go bullish again. But that's going to be, you're looking out 3 weeks, a month before that's even a possibility. Some additional things, though, that I think some events we need to talk about. Elon Musk is cutting 10% of Tesla's workforce, or that's what he demanded things. He's not cutting the people on the line, so it's a lot of management, and you're going to find that get in the way because Elon himself says he's got a really bad feeling about the way the economy goes, and Jamie Dimon said as well. Look, there could be a hurricane of economic conditions coming up. They honestly don't know any more than you or I know, but they're looking at the same data. But that's what they're banking on right there. Take it with a grain of salt. But if you got two of the smartest people out there saying, we're in for some economic things, it's up to you where you want to take that.
And Darren, let me throw in one more into the mix. The Fed officially started removing stimulus, removing money supply. There's a lot of things where you can look back in history and say, oh, well, then this is what happened in 1930, and so we have a blueprint. We've never seen this kind of stimulus before. We don't know what happens when the Fed reduces the money supply. We don't have any time in human history to go back and say, oh, this is what to expect. I think that is, we just have no idea what that's going to do. So I think, Darren, you're right. I think Elon Musk is right. I think Jamie Dimon is right. I think at this point it is murky. And when it's murky, you should be worried. Now, that doesn't mean panicked, but just worried means like, oh, I've got my head up. I'm looking around. There's danger around me right now. If you just have your head in the sand, you'll never see the danger. But what's happening is some smart people are saying, hey, everybody, there are some issues out there. If you take a look at the crypto land, the cryptos are getting absolutely killed. They're getting slaughtered, and there's no bottom to them. Coinbase, they announced that they're going to be laying off a bunch of people. Cryptos are most likely going lower. It's, again, when you take a look at where the market is, what the market is doing, it's telling you to be very, very skeptical of a bull market. That being said, we put in a pretty good bottom here. And we're going into the summer months. So if you want to take it just a big wide range here on the Qs, maybe we trade somewhere between 280 and 320 for the summer. And we just simply go sideways. Now the VIX has come in quite a bit. And Darren and I were also talking about this. So Darren, do you want to kind of go over what you were saying to me earlier for everybody?
Yeah, this is one of those interesting things where we talk about volatility, okay, and this volatility index, the VIX, we talk about, we just kind of throw it out there. You need to look at this is just a measure of how many people are hedged against losses. The higher the number, the more people are hedged, the greater the fear. They're afraid of losing money, so that's why they get hedged. You see that the entire week, the VIX came in, but we had that really volatile price action. So I think you said it best, Rob, is we're now discounting implied volatility but we're adding to some very short-term historic volatility with the moves in the market. So this is another one where I think, this is just me, but I think we're setting ourselves up for a big move one way or the other. In my opinion, it's to the downside, just because they're not fearful of the market. But despite the fact that we're getting these wide daily swings with no real discernible direction, they're losing their fear. And I think that's when the dog bites us. And I mean, you put it best. This is a market that is going to screw everyone. And I'm waiting for the dog to snap his jaws and see how many fingers get taken off. I mean, that's where it is right now.
Yeah, I totally agree. So let's talk about this week's events. I got the markets looking trendless but volatile. So as Darren said, the abject fear and panic that we saw 2 weeks ago is no longer there. And that's why the volatility index is coming down. And I really don't like the name for it, the volatility index. It doesn't actually measure volatility. It measures put and calls bought against the S&P 500. But it just, again, it's, as Darren said, it's a measure of fear, how much people are hedged against market movements. But I think we're going to probably be in this lower range of the market for most of the summer. And I'm with you, Darren. I think the next major move is to the downside. But I think in the short term, I think you have to expect all rallies to fail and all sell-offs to be bought. So if you are going into trading with the attitude of everything I go long on a breakout is going to fail on me, and everything I go short on a breakout is going to fail on me, the question is, number one, how can you even trade? And number two, should you even trade? And I think those are two very good questions. I'm going to throw a third one out, is how can you trade in that environment? And that's what I'm going to get into, and Darren's going to get into when we get into our picks for the week, is you're going to see the picks we're doing this week. The strategies that we are looking at are very, again, I'm going to call them +1, -1, meaning they are slightly directional, but with positive theta. I think that's the way you play this. And you either have to be very short term or you've got to be very long term. Interest rates are back to 3%. And that was the one thing that happened this week that I think did spook the market a bit. Remember, high interest rates, we haven't talked about interest rates since the war started, but the interest rates were the thing that caused the market to move significantly lower in January. What happens is when there's high interest rates, companies that are not profitable, who are need to go to the bond market to raise capital to pay their bills, all of a sudden it gets a lot more expensive to go do that. It's very negative for these kind of stocks. So if we go back above 3%, I think, again, you take a look at the NASDAQ and you say, you know what, it's not safe. The NASDAQ is not safe with interest rates back above 3%. Darren, you have any comment on interest rates?
I think the Fed needs to do this. The Fed needs to raise the rates. I still think that they are behind the curve. But you're right. There's a whole cohort of chief financial officers that are developing peptic ulcers right now because they've got to go to the capital markets and it's getting prohibitively expensive. I think that the best way to put, we've been addicted to low interest rates for the past 13 years. 14, you go back to 2008, call it 15 years. We've been addicted to these low interest rates. The economy has to go through rehab right now, and nobody's looking forward to that. We just don't know what to expect.
Yeah, and again, uncertainty is going to hit these high flyers more than anything. So, I hear people say, "Oh, Rob, what about this stock? This stock's down 65%." Well, guess what? Stocks went down 80% in the NASDAQ crash of the dot-coms. There's still more downside to go. Friday CPI, that's going to be a big one. But other than that, there's really no economic reports on the table. So this week, we are really being brave here. Super brave, Darren. We are at a 0 and a 0. Look, that's not a boring 0 and a 0. That's a very exciting 0 and 0. What do you think? Think we're pretty brave here, Darren?
Yeah, I mean, we were looking, if the markets would have, I think we had a +1 or a +2 last week, and I think if the markets would have quit trading on Thursday, we'd look really good. Is just I see nothing but volatility. I mean, you take a look at this market action, even though it happened, we really didn't go a whole lot. We ended up down 1%. It was no big deal. We wouldn't even blink in a trending market with this. But this is going to be one of those ones. Very difficult to trade. Cash is a position. Go look at a balanced portfolio. And I think we're banging this drum. You either have to be very, very short term or very, very long term. I mean, you're playing Frogger if you're in that 2-week, 3-week time frame there, and it's very easy to get run over, in a market like that.
Darren, you're really aging us with your Frogger comment. Some people have no idea what you're talking about.
Probably half the people are going to have to Google what Frogger is.
For sure. Now, here's a good thing about the markets. So the equity markets are murky. It's a mess. As you can see, we're not sticking our neck out at all to call the overall markets. Here's a good thing. There's some really good trends in the sectors.
Oh, thanks for that segue there, Rob. Yeah, we're doing pretty good. Let's take a look at some of these sectors. You can see there, by individual sector, it's telling a bit of a different story than you're getting in the broad markets, and we'll talk about that a little bit more. Healthcare took an absolute bath, and I will follow my sword. I think I had healthcare at a +2 last week, and it's down 3. So for whatever reason, healthcare's fallen out of favor. Real estate. Real estate was going strong for a good part of last year, and we were bullish real estate. It was just real estate was just not looking good anymore, and that's fine. As the trends change, we're looking at how we can profit from them, trade the market on a view, and I can't stress enough. Go do your top-down approach. You take a look at the broad markets. If they're not showing you anything good, you got to go into the sectors before you take a look at the individual stocks. I mean, you can find things so much quicker, be so much more responsive by looking at the sectors right here. Energy, up 1.11%. Energy appears to be about bulletproof right now, and I like it. Financials is another place that it looked like it weakened pretty good. But you also have to realize that we had a 6 to 7% rally the week previously. There might be some consolidation in some of these sectors. Let's take a look at utilities right here. I'm actually pretty happy with utilities right now. It held up pretty nice. I'm at a +2. I don't usually go, more than a +1 because utilities moves so slowly usually. But hey, this is above the 20, above the 50. I like it. I think it held in really nicely. I think there's some upside in utilities. Communication services here, I'm at a 0. The action was okay Tuesday and Thursday, but it fell right back down. Just not a lot of velocity to the upside here. There's other sectors out there that went higher. They're more above their 20-period moving average than communication services is. I just don't see the appetite for going long, going on a limb on communication services. So I'm at a 0 on there. Real estate's another one that I'm just kind of meh about. You look at the market action. Couldn't hold last week's gains very well at all. So I'm at a 0. I think we probably base here. When you take a look at the range of those candles, there's still going to be some volatility. I just don't think we end up any real place, for the next couple of weeks. Looking at industrials here. Again, this is another one. This is a little bit stronger. You can make the case for a +1, but looking at how it performed, I just think that, it probably doesn't go anywhere good. It's got a little bit of overhead resistance. It needs to clear out, locally. Like I said, I had to make a flip a coin on this one between a 0 and a +1, and I ended up at 0. If you want to call it slightly bullish, go right ahead. Healthcare, though, this one went from a +2 last week. Think we're going to get a very nice movement, and now I'm at a -1. Look at the market action all week. I mean, you try to bounce a little bit on Thursday, but you can see the direction has just been all down. So, a 3-point change in 1 week, just from the way that market action went. And here we can see financials. I'm at a 0 on financials. I mean, we were pretty. Uh, I was mildly bullish last week, but you can see it was just a slow stair step down for the 4 days that the market was open. Couldn't hold any of the any of those gains. I mean, it was down a little bit. So I'm going to say we just trade volatility. We trade volatility, and we're in between that 20 and 50 period moving average for a couple of weeks. So 0 on financials. You can see consumer here. I'm at a -1. Just the price action, it tried to make some gains. It just couldn't. Despite Tuesday, it tried to make some stuff on Thursday right there, fall down, lower range of that candle. I think we got a little bit more room to the downside in consumer. A lot of things were getting hit in that sector. So that's where I'm looking for some of my bears. Tech is another one that I'm just going to say we're stuck between that 20 and 50 period moving average. I'm at a 0. There is going to be, again, volatility in this sector. We'll wait to see how earnings comes out for a lot of these things, but I think we end up just in a holding pattern for a little bit, much like some of the other ones. Materials, I'm actually pretty happy with here. I'm at a +1 on materials. You can see it's had some very choppy action the past 2 months, but I think we're coming in pretty good. Materials has done really well the past couple of weeks, even though you can see the range on those candles is very volatile. Now, in the materials sector, make sure you're looking at the industry groups as well, because some are looking good and others are not. But on the whole, I'm bullish on materials. Which leaves us with what's turning into our perennial favorite here, energy. I'm at a +2 on it. We are extended, yes. Is there going to be some resistance up there at the 90? Could possibly be. But overall, if someone said they wanted to short energy, I would say you're going to lose money. This is one that is, like I said, bulletproof, and I really like the market action on this. So to stack everything up together, you can see down at the -1, we've got healthcare and consumer. 5 sectors at a 0, technology, financials, industrials, real estate, and comm services. Those are all stuck between moving averages, and I think don't go anywhere but have some volatility. Mildly bullish at a +1 on materials, and utilities and energy at a +2. So let's take a look at some potential trades that we're going to be taking a look at here. So last week in the utility sector, we were long Vestra Energy, VST. And I'm going to be upfront here. Our trades this week are a mixed bag. We've got 2 that we're really happy with, and the others just kind of had some winners, had some losers. Not a very exciting week for us. So we were long Vistra, that was down 1 3/4%. This week we're going to be taking a look at real estate. We haven't taken a look at real estate for a couple of different weeks. So we're looking at Store Capital, STOR right here, and we're going to you can see we had a nice little bear rally. It looks like we failed on and confirmed on Friday. So you could play this down. I think we're gonna play it out to June, so we're about 2 weeks away, and it's just going to be a really kind of wimpy 26-28 bear call spread. Now, what we're looking at here is we're looking at stuff that we can get some theta out of, and when you're selling spreads like this, if the volatility is high and it begins to come on down, it's actually better for you. This is one that you want to be theta positive. You're also short volatility like this. Don't do anything naked in this environment. Okay, we don't let our traders do it anyway, but if you're thinking about joining us, don't do any naked spreads on this. The premiums look good, but the margin requirements are just horrendous, and you're not looking pretty good here. So 26-28 bear call spread right there. So communication services, last week we were long T-Mobile, TMUS, and we were mildly rewarded, up 1.86% on T-Mobile. So nothing to write home about there. This week, though, we're looking at Twilio, and nice little bear rally right there. You can see it's come down from 240 several months ago. Just can't do anything. I mean, we're down to 100 right now. It's lost over half its value in that time frame, and we're just in this, what looks to be a low base right there. Being called a bear rally within a low base. If you want, this is one where we're going to play it down to support. So just that, June 100, 105 bear call spread. It's the same thing right there. One of the, as much as this thing moves, it is one of the wimpiest trades that we can make. I am fine with that. Let me just hit some singles, maybe get a couple of walks, and I'm going to be happy. There's no swinging for the fences right now. In healthcare, last week we were long Agilent, symbol A. Again, not one of the better weeks. This was down 1.58%. If you got more time on that trade, you're probably going to be fine, but it's just volatile right there. Look for it to do something. This what we're looking for in healthcare right now, Pfizer, PFE, bull pullback within a sideways chart pattern. You can see we've been sideways for a couple of months. I mean, there you've got resistance right there, but that 450 level, and we've got support way down at 48. But right here, looks like we found some support at the 20-period moving average. We're right there at the about the 51.75 area right there. So now here's where we're talking either very, very short term or very, very long term. So we're going to go out to July and go long the 50s, and we're going to short the June 55. So it's a little diagonal call spread there. You're just playing the next 2 weeks that we drift up over to that 55 area.
And Darren, I really like that diagonal call spread, because if you want to watch paint dry, do a 2-month out diagonal call spread. So what happens is, if you open up this position, do the 50, sell the 55, and the market goes crazy on Monday, Tuesday, you're going to see virtually no movement, good or bad, in your trade, because it's far enough out to where that volatility just doesn't hit it that much. Then as we get closer and closer to that short strike, now it starts to become more important. But if you push these trades out a little bit further, any short-term volatility is not going to put you under pressure all that much. In the industrial sector, we had MAS last week. It was, again, as Darren said, some of our trades are mostly a mixed bag. It was down 2.6%. So we were long MAS, went down 2.6%. I know I've still got another week on that, but we'll see what happens. This week, going sideways here in the industrial sector, Southwest Airlines. Now, this is what we talk about when we say we have a session called Anatomy of a Sideways Trend. This ticks all the boxes. We have flip-flopping moving averages. We've got ranges above. We got ranges below. So looking at this one for a sideways, the big question is, where do we want to pin the middle? And for me, I'm looking at 45. 45 for the middle, and then just do the 40s and the 50s. It's a pretty simple trade. If it ends up in here, anywhere in here by June 17th, you're going to have a profit. If it ends up anywhere outside of that, you're going to have a loss. It's a pretty simple trade here on this one, and I think you look to hold this one till expiration for 2 weeks. In financials, last week, this is one of our good ones. Like I said, most of them were like plus or minus 2 or 3%. This one, we had Marathon, which is a cryptocurrency stock. We had it short, and it plunged 14.3%. So nice trade on MARA. I know I saw a couple of our traders in that one as well. This week, we're going to go to the long side and look at Unum. Now, Unum is an insurance company. They're a big insurer, and someone has forgotten to tell this stock that there is a bear market. Someone has forgotten to tell them that, you shouldn't be at their highs of the year, but it is. So the big question is, when does this thing break higher? Of course, we don't know that it is going to break higher, but, this is the chart pattern. We've had higher highs, higher lows. We're hitting up against this resistance. The question is, when does it actually break out? Now, this is where I love to use diagonal call spreads again. So I'm looking up at the 37.50. So at the 37.50, I'm going to open up a July call, and I'm going to sell this 37.50. Now, when I do that, I'm basically reducing volatility. I'm not just reducing theta, but actually making it theta positive. This is a very slow trade. It's going to be something that I'm going to have to wait 2 weeks on, and then on June 17th, I'm going to have to take a look at it and make a decision. Do I think it's actually going to break out and run higher? If I do, then I just let that call expire and hold the long calls. If it's just hanging out in this area, I'm going to have a very small gain and I'll just pack up my bags and leave. And if it breaks below some of these moving averages, I'll just go ahead and pack my bags and leave as well. Again, not exciting trades, but we trade the market in front of us at Maverick. And right now, the market is not ripe for exciting trades.
Yeah, consumer. Last week we were long, I think, international paper, IP. Now there's another one, down 4.5%. So we're just book the loss on that and move on. This week we're looking at Wayfair. The symbol is W on there. Nice bear rally right there. Again, we're going to go out to that 2-week mark and just do the, we had it confirm on Friday. We're just going to get out there and do the June 55-60 bear call spread. We're right at 60 right there. So, you take a look at the scaling on this thing. We're not, that could be taken out in 1 or 2 days. So it's going to be a delta dependent trade. Not only just theta positive. You're going to have some delta movement in order for this trade to work. But with the way that Wayfair has been trading, I think this is a decent bet to put a little bit of money on. And technology. Last week we were sideways to bullish on AMD, and AMD closed up about 3.9%. So that's about where we expected it to be. So we're happy with the way that one went. This week we are going to be looking short on Fastly, FSLY. Beautiful bear rally, and you see it went up there, barely clears 20-period moving average, and then started to bleed back down. Could not get any other momentum right there. So that's the one that's looking good right there. So what we're going to do, we're going to go out to July. We're going to get the $14 puts, and then we're going to short this Friday's June 10th, 12 on it. So we're just expecting a little move down about 45 cents over the next 5 days, and then decide what we want to do, right there. So this is one that we're happy to bleed off, 5 days worth of time on and reevaluate. But this is definitely one we'd like to do this on.
Last week in materials, we called for a short in CF Industries, and it basically went nowhere. It was up 0.1% on the week. So if you got more time, that one still looks like it's going to work, but just didn't get any action last week. This week, we're looking on the long side at ArcelorMittal. It is a steel maker. I believe they're Swiss. Actually, no, I think I looked that up. I think they are American. Now I'm going to have to look it up. I just looked it up, and it was Luxembourg is where they're headquartered. So not Switzerland, not the U.S. But again, a steel company. And what we see here is, look at this price action over the last couple of days. So when you take a look at the material sector, we like the material sector. When you take a look at the steel stocks are doing pretty well. This one is, got some overhead resistance at 34, but the price action here over the last 5 days says after this massive rally from 27 to 33, there's buyers there. There's definitely buyers here. The problem is we've got a lot of overhead resistance. So the question is, how can you make a trade on a stock that's showing some short-term strength but has some pretty stiff overhead resistance? My favorite strategy, the good old diagonal call spread. So what we're going to do here is we're just going to take a long position, and then we're going to sell this 35. We're just going to sell right above this resistance, fully knowing that it's probably not going to take out this 35 area. But the reason we're doing that is that we're going to be reducing the cost on our 32 calls, and we're also going to be reducing the theta and possibly even getting to positive theta. And what that's going to allow us to do is allow us time to just sit and wait. And if it does start to move its way up to 35, this is going to be a really nice trade. But if you see here, we were only giving this a week on the short call. After that week, we're going to reevaluate. We're going to reevaluate it. And like I said, we either hold that July 32 call or we dump the whole trade. In the energy sector was another home run of ours. We chose VTNR, and it had a nice move on Thursday, Friday, closed up 14.7%. So I saw some traders in that one. Great job on that. This week, kind of a similar one on Taro Resources. So we get this big major rally from 35 up to 45. So we're talking about 10 points on the 35. This is almost a 30% run here. Now, when things run 30% in 4, 5, 6 days, they usually have a pullback. Again, it's a big burst. A lot of people are excited, and then people say, oh, you know what? Let me take some profits. This one, nope, no one's taking profits. So it's a good sign here that this one's going to hold on to its gains and possibly go higher. For me, I'm going to still go with this diagonal call spread where you're just saying, okay, I think it's going to go higher. I'm not totally sure. So we're going to be selling this at the money. So we're going to sell this 45 at the money. That's going to bring in a pretty big chunk. And our risk graph is just going to look like this. We're basically saying, okay, 45, probably down here to like 43 is going to be our point where we go into a loss theoretically. We're basically saying we think it's going to stay up above this area. That's what the call is. And you can see we're going out 2 weeks. So we're getting the July 42, selling the June 45, and just letting that trade develop. Hopefully you can see that this week we have not really stuck our neck out for anything. And I think you're going to see that for at least the next couple of weeks. You can still trade. You can absolutely still trade this market, but you have to trade it the right way. You have to understand the market conditions we're in. We're in a market that's off the bottom, but every rally is getting sold off. But every time it dumps, people come in and buy it and rescue it. Companies are announcing bad earnings and they're going up anyway. This is a difficult market to try to figure out where the market's going to be in 1 to 2 weeks. As Darren said, and I will echo that, shorter term or longer term. That's where you got to be right now. So for me, diagonal call spreads are great because it gives you both. I can play this short term. I can sell next Friday's option. And then on Friday, I can look at the whole thing again and say, hey, let me make a decision on this. And they're going to be a slower moving trade where volatility isn't going to affect them as much. And you can just sit and let the trades develop. So to wrap this up, you have to recognize the market we're in. And we put, was that it? Was that rally it? Who knows? It looks pretty anemic. However, we didn't fall apart. We didn't fall apart and give it all back. And so the overall market's a mess. I think you have to go into the sectors because they're telling you where the money's going in these sectors. Be short and bearish in the sectors that are going lower. Be bullish in the sectors going higher, which is only a few of them. Energy, utilities. That's where you want to take a look at this market. You can still trade, either be shorter term or longer term, but I really think that 2 to 3 week time frame window is going to be very tough to hit because it's really going to depend on the last 2 to 3 days of the week to determine whether or not you were right. And that's just a tough position to put yourself in. Thank you so much for joining us. Everyone have a great week. This week we're going to be meeting 3 times. So how to trade earnings on Tuesday. Join us live for that midweek update as usual with Joe. And then Joe decided he wants to throw on one of the trades that everyone comes with together in the midweek update. So Thursday, we're going to be doing a live trading lab. Joe's going to take one of the trade suggestions from one of our traders on Wednesday and actually build the trade and put it into place. That is it for us. Thank you so much. Have a great weekend. Stay safe. Goodbye, everyone.
Good trading, everyone.